Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. So as the SP 500 continues its rally off the October low, as the market is pricing in lower inflationary data, potentially seeing yields roll over, peaking here. That's really been the primary driving factor behind the rally here, just like it was in August, where the S&P 500 rallied as bond yields were coming down, helping boost valuations. But now we're getting into some tough resistance levels here. We're encountering this downtrend line resistance, and again, after a 16% run off the low. But today we're going to step away from macro a little bit, and we're going to discuss the strength of the rally that we're seeing, the breadth of the rally that we've seen off this low. Because just looking at the price action doesn't really tell you much about what the underlying internals look like. If a lot of stocks are participating in this run, it means potentially it can sustain for a lot longer, right? And we're going to compare that to the run we had in August. We're going to compare it to previous moments in history and try to understand the odds of this rally failing or this rally continuing much higher. That's exactly what we're going to talk about in this video. By the way, if you are new here, don't forget to smash that subscribe button, because we post videos like this multiple times a week discussing what's happening on the markets. Now, without further ado, let's get right into it. So more specifically, I want to discuss this chart here of the S&P 500. Stocks above their 200-day moving average. And you can see we've had quite an interesting move here, where stocks above their 200-day moving average have gone from around 10% here to 56% of stocks trading above their 200-day moving average in a very short period of time here, from very oversold to most stocks having recovered above their 200-day moving average. So you can see, just looking at recent history, we saw this type of run back here in June of 2020. We saw this run back here in February of 2019. Both of these very interesting moments for the stock market. If you add the S&P 500 on top of this chart, you can see it marked the beginning of much larger runs in the market, of bull runs, right? This strength, this initial strength really told you, yes, the market is strong enough here. There's broad enough conviction in the market that it's really a sign that investors are getting excited about a much more sustained run on the S&P 500. Now, interestingly, we did see a very broad rally here in August. You can see the market moved from around 10% of stocks above their 200-day moving average to, at the peak in August here, around almost 50%. It just tagged 50% of stocks trading above their 200-day moving average. So we did get that type of rally. So this is obviously to take with a grain of salt, but you can see here on this recent run, even though it looks perhaps less impressive from a technical standpoint on the S&P 500 itself, the participation is very broad. It's very full of conviction here. But of course, just looking at the past couple of years is not enough. We have to look at bear markets. We have to look at how this indicator behaved during bear markets and bear market rallies. So that's what we're going to do here in this next part of this video. And by the way, if you scroll down just under the video, there's a gray thumb. Make sure to hit it as hard as you can. It makes a massive difference to the channel. It helps push the education and the information that we provide in these videos to more people, so it is really appreciated. By the way, it is Black Friday, and we are doing a big discount. We rarely do discounts, and we definitely don't do discounts this big, so make sure to take advantage of it. So we have so many projects that are coming up over the next few months that are going to be designed to really help you navigate the market more efficiently, be prepared, and understand what the best assets are to position in the current market environment. And of course, the ideal allocation for these assets. And that's all highlighted in a concise, clear, and actionable way for you guys. Now, before we look at these bear market rallies and how the breadth behaved in these periods, I want to quickly mention a side note here. We recently posted an article going quite a bit in depth into why the dollar has more downside from here. Now, just in case you missed it, the dollars, or the DXY here, the US dollar currency index, well, first of all, it went on a massive run throughout 2022 here, as we had the energy crisis, as we had inflation, the Fed tightening very aggressively. But more recently, right here, it broke down some key trends, key moving averages, key trend lines. And so we wanted to figure out whether or not we should see more downside on the dollar from a fundamental standpoint, whether that's likely. And the reality is that there's a big bearish case on the dollar to continue moving down. Now, of course, we can see a tactical bounce here following this oversold reading, but ultimately we think it's heading lower, and that has massive implications for the rest of the markets. Portfolio performance is greatly influenced by what happens on the dollar, whether that's to the upside or to the downside. And so we're going to be adding a few ideas to the model portfolio over the next few weeks that try to take advantage of that in the best way possible. So back to the topic of the video, let's get back to this chart here of stocks above their 200-day moving average and zoom out a little bit back to 2007. Now you can see I've put a vertical line here at around 14% and a vertical line at 56%. Basically what we're measuring is every time the participation rate of stocks within the SP 500 goes from below 15% to above 50%, right? And we're measuring every time we see that type of thrust. If we go back to 2006, we see it has only happened 1, 2, 3, 4, 5 times. If you look at where those instances were, of course, we had these two examples we discussed earlier. We have 2016, we have 2011, and we have the bottom of 2009. Very, very attractive buying opportunities. And if we go back and see what the behavior was throughout 2007, we didn't see any type of rally to this extent, right? We didn't see a move from below 10% to more than 50% of stocks. Now, we did have a bear market rally here in 2008 that peaked in May of 2008. That was the best moment to be getting out of the stock market, but that definitely had less conviction than the rally we have today. Now, one of the big arguments I've heard more recently is that in each of these cases, the Fed was easing. Now, first of all, perhaps that's coming sooner than you think, and the market is front running that. So that's the first comment I want to make. But the second point is that in this bear market rally in 2008, arguably, you could say the Fed was easing very aggressively here. The Fed funds rate had just gone from around 5% at the peak to 2%. So they cut rates massively. That should have propped up the markets, but it didn't, right? So there's a lot of other components that are at play than just the Fed. The Fed is important, right? But sometimes the Fed is powerless against a falling stock market, and sometimes the Fed is powerless against a rising stock market. We've had many moments throughout history where the market was rising during a tightening cycle, and we've discussed this before. A beautiful example of that is between 2004 and 2006, where you had a big rate hike, and then during the Fed pause, that really was the final blow-off top move to the market top, which potentially is something we're going to see throughout 2023. Now, if we go back further in history and we include the 2001 bear market, right? So the tech bust. And we look at the behavior we had throughout this period. Did we have any breadth thrusts? Clearly throughout 2007, no breadth thrust, right? Never at one point did we see anything like we're seeing today. But that said, in 2002, right here, we did have a very similar reading right there, where we had the breadth go from around 15% here at the bottom and all the way to 75% at the top right there. So that was a breadth thrust during a bear market. So, you know, you have to have the exception to have the rule. Over the last 20 years, we've had this signal really 7 times, and one of those readings failed to predict further upside on the market. That's the grain of salt that you need in order to fully appreciate this video. I hope you guys enjoyed. If you did, again, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.